Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
Here is the U.S. market analysis for Wednesday, April 1st, 2026.
This video presents a direct informational narration of the source document.
Okay, here's what we're covering. We'll start with a market performance review, then move to the geopolitical and macro analysis. After that, we'll look at the CTA liquidity update and the JP Morgan Q2 volatility range. Then we'll cover a core stocks trading strategy, and finally, we'll wrap up with a summary and our April outlook.
And just before we dive in, here is the risk disclosure and important notice. This is for informational and research purposes only and is not investment advice. Investing involves significant risk. All the views you'll hear are for reference only, and past performance doesn't indicate future results. Also, the information is time-sensitive.
All right, let's get into our first section, the market performance review. We're going to take a look at today's price action and the key levels to watch.
So the story of the day was really a gap higher, fade lower situation. The market tried to push up, it ran right into some core resistance zones, and then just fell back under pressure. And when you look under the surface, the market breadth tells you everything you need to know. There was a huge internal divergence. In the S&P 500, you only had 30 stocks moving higher, while a whopping 198 were on the decline. That's not a healthy sign.
Now, let's talk about those specific resistance areas. For the SPY, we're looking at a heavy zone between 653 and 672. For the QQQ, that ceiling is between 588 and 613. The market's really struggling to get through those levels. The key thing to watch for next is the presidential speech tonight at 9 p.m. Eastern. Everyone's waiting to hear about NATO developments and any hints about a ceasefire.
Okay, let's move on to our second section, the geopolitical and macro analysis. We're going to examine the primary things that are driving how risk is being priced in the market right now.
Geopolitically, all eyes are on the Strait of Hormuz and whether it's going to stay open for navigation. The diplomatic messages we're getting are completely at odds. You have Trump's camp signaling they're willing to talk about a ceasefire, while Iran's parliament is flat out denying it. At the same time, we're seeing military escalation, with the U.S. planning to double its A-10 Warthog aircraft in the Middle East, specifically to target Iranian vessels.
So how do we track this risk? Well, we watch the price of oil. Right now, Brent crude is pulling back toward $100, but its core trading range is really between 90 and 96. WTI is in a tighter range, between 85 and 88. The key thresholds to watch for a war premium fade, that's the extra cost baked in for risk, would be a decisive break below $90 for Brent and below $85 for WTI.
On the macro front, the data is telling a few different stories. The labor market is resilient. The March ADP numbers came in stronger than expected. Consumption is also strong, with retail sales rising 0.6% in February, which was the best reading in 7 months. But on the other side of the coin, manufacturing cost pressures are intensifying. The prices paid index in the ISM report surged to 78.3, which points to inflation.
Now for Section 3, the CTA liquidity update. This is really interesting because we're going to talk about a potential explosive buy trigger mechanism that's lurking in the market.
Okay, so let's talk about CTAs, which are big, systematic trend-following funds. After that big one-way decline we saw, these funds are basically in a fully sold, short position state. What that means is their remaining sell flow is pretty much exhausted. We're estimating there's only about $5 billion of selling pressure left from them. But here is the flip side. If the S&P 500 were to break above the key level of 6735, it would trigger a massive wave of short covering from these CTAs. And the estimated demand is huge. We're talking about $47 billion.
This brings us to the concept of convexity. It's a powerful market dynamic where, as prices start to rise, the buying actually has to accelerate. This can create a really non-linear squeeze, a dynamic that's powerful enough to completely blow out the short sellers.
Let's shift gears to Section 4, the JP Morgan Q2 volatility range. This gives us a great look at the institutional consensus framework, basically where the big money thinks the market is headed.
So JP Morgan uses what's called the collar strategy. For the June 30th expiry, they have long puts, which is their core protection, in the 6150 to 6180 range. Then they have short puts, which act as extreme downside support way down at 5190 to 5210. And on the upside, they have a short call position between 6840 and 6865, which acts as a quarterly profit-taking ceiling.
So what does this tell us? Well, the institutions see a market floor around 6150.
They see that as a really protected level for the S&P in the second quarter. The market ceiling, or the upside cap, is seen at 68.65. But, and this is a big but, there's a risk warning here. If the market were to violently break above that ceiling or below that floor, it could trigger what's known as a systemic hedging storm.
All right, let's drill down in Section 5 to our core stocks trading strategy. We're going to look at some technical levels and a really interesting leadership divergence that's happening.
You can see this divergence clearly in the semiconductor space. You've got the sector leader Marvell, which is showing strong momentum after breaking out through 94.1. Its first target of 109 is getting close. And then you have a laggard, Broadcom, which is just heavily constrained by resistance at 363. Its technical profile is just materially weaker than Marvell's.
Looking at other core stocks, we see a similar story. NVIDIA had a breakout failure and is now capped by heavy resistance at 175. Tesla is just trading in a range between 315 support and 420 resistance, and where it is now, the risk-reward looks negative. Microsoft and Amazon are both retesting after losing key support levels, and even some high-momentum names like Micron and Eli Lilly are stalling out.
That brings us to our final section, the summary and April outlook. Let's put all these pieces together to understand how we should navigate what looks like a critical inflection point for the market.
So, for our April outlook, here's the bottom line. The market is capped on the upside by geopolitics and inflation fears, but it's bounded on the downside by that CTA explosive buy trigger and the JPM collar range. This all points to an environment of elevated volatility. For things to really stabilize, we need to see a genuine reopening of the Straits of Hormuz. So for now, the advice is to remain cautious and keep a very close eye on those systematic liquidity signals.
And we'll end with the full professional risk disclosure, an important notice. Remember, this is for informational purposes only and is not investment, financial, or trading advice. Any decision you make is at your own discretion and risk. Please conduct your own independent research. And as always, past performance is not indicative of future results.